I need you to stop what you're doing. Put down the charts. Because what just happened in silver is the kind of move that doesn't just take money. It takes confidence. An 8% drop in 5 hours is not normal price action. That is not a healthy pullback. That is a message. And the message is this. Somebody just ran a fake out at $84, and the market used the drop to test one question. Who is actually selling and who is refusing to sell? Because if you think tonight was just profit taking, you're not watching the real game. You're watching the screen, and the screen is where people get hypnotized. The system is where people get wrecked. So in this video, I'm going to do two things. I'm going to explain exactly what that $84 fake out was in plain words, and I'm going to explain why China isn't dumping silver into this, even with price this high, even with volatility this violent. Because if China isn't selling and the West isn't stocked, then drops like this aren't bearish. They're shakeouts. They're the market testing how weak you are. Now, before we go any further, I'm not here to sell you dreams. I'm here to give you a framework, no rumors, no trust me, bro. Just what the move means, what caused it, and what signals matter next. All right, let's go to the crime scene. The 84 moment, why it felt like a breakout. Here's what most people felt emotionally. Silver was climbing, momentum was hot, the crowd got loud, and then, boom, 84. And the second it touched that level, you saw the posts start. It's over. Triple digits tomorrow. They lost control. That feeling is not an accident. That's how traps work. A trap has to feel like freedom right before it closes. Because the easiest way to remove people from a position is to let them get confident first. So what was $84 really? In most markets, a number like that becomes a pressure shelf. It becomes a place where old buyers want to take profit, new buyers chase late, and leverage players pile in at the worst moment. And once leverage piles in, the market doesn't need bad news to fall. It only needs one hard shove. Because leverage turns a normal pullback into a waterfall. And tonight, we didn't get a pullback. We got a cliff. The 8% drop in 5 hours, what that actually is, let me be blunt. An 8% drop in 5 hours is not silver being silver. That is a forced move. Usually it's a chain reaction that looks like this. Price tags a breakout level. That was 84. Late longs jump in with tight stops. Options dealers adjust hedges. Margin rules tighten as volatility spikes. Weak hands get forced out. The sell-off feeds itself. And here's the part nobody wants to admit. Most crashes in a squeeze market aren't caused by bears being smart. They're caused by bulls being over-leveraged. That's why these drops always feel personal. Because they're designed to hit the exact people who entered emotionally. Now listen carefully. This is not a silver is dead signal. This is a liquidity test. It's the market asking who owns real metal and who is renting exposure. Because renters get evicted fast. Owners get shaken, but they don't get forced. And that difference is everything. Why this was a fake out, not a failed story. People hear fake out and they think it means price goes up, then it goes down. So the breakout was fake. No, a fake out is more specific. A fake out is when the market does this. It gives you a clean, beautiful breakout, just long enough to pull in maximum late money, and then it snaps back hard enough to liquidate the weak structure. It's not random, it's cleanup. It's the market vacuuming out unstable positions. And that's why $84 matters, because $84 wasn't just a price. It was a leveraged magnet. It was the point where the most people believed the least amount of risk existed. That's when the market becomes most dangerous. So if you're looking for the reason silver dropped 8%, the reason is simple. Too many people were positioned the same way at the same time, and when everyone is leaning the same direction, the smallest shove becomes a stampede. Now we get to the part that actually matters, because the West loves to tell itself a bedtime story. China will dump supply when prices rise. China will keep the world balanced. China will sell to capture profit. That's how Western traders think. They think in quarters. They think in fast profit. They think in monetize the rally. China often thinks differently. China thinks in industrial continuity and strategic advantage. And here is the reality. China does not look at silver as a meme. China looks at silver as a critical input, a material you don't gamble away if you need it to keep factories running. So when people ask, why isn't China selling into this rally? Here are the real answers. Reason one, they need it. Silver is not optional for modern industry. It's used across electronics, high-end manufacturing, solar supply chains, power systems, and a long list of components people never talk about. If your national strategy is control advanced manufacturing, then you don't sell the key ingredients cheap just because the chart is hot. You keep it, you stock it, you secure it. Reason two, when supply gets tight, the seller becomes the ruler. In a normal market, sellers compete. In a tight market, sellers dictate terms, and China understands that power, because if the rest of the world is short physical inventory and China has supply, then the real profit isn't in dumping today, the real profit is in controlling access tomorrow. Reason 3, they can let the West panic. This is the part nobody says out loud. If the West runs just-in-time supply chains, and China runs stockpile-first policy, then volatility becomes a weapon, because Western buyers are forced to chase. They can't wait. They can't risk a shutdown, so they pay whatever the market demands. In that world, selling early is not smart. It's weak. China doesn't want to be the weak seller. They want to be the last seller, the one who names the price. Reason 4, silver is also a currency hedge. If your view is that global money systems are unstable, then hard assets become strategic. Not because they go up, because they don't get printed. So even if China is not cornering anything, they have a strong incentive to treat physical metal as protection, not as inventory to dump. What the drop was really trying to do, shake out your metal. Now let's connect the two stories, the $84 breakout, the 8% crash. Why do this? Because in a tight market, the real prize is not your opinion, it's your supply, it's your metal, it's your willingness to sell. And there are two ways to get metal from weak hands: boring sideways action for months, violent spikes and crashes that scare you into selling. We are not in the boring phase, we are in the violence phase. That means somebody is hunting, and they are hunting one thing: loose ounces. Metal sitting in hands that can't emotionally handle volatility. Because the moment you sell in panic, someone stronger buys in silence. That is how supply consolidates. That is how control forms. The two worlds: screen price versus real price. This is where most people get confused. There are two worlds. World A, screen world. You see candles, you see spot price, you see a 5-hour dump, you feel fear. World B, real world. You see premiums, delivery times, wholesale tightness bar availability bids from industrial buyers, import-export behavior, stockpile behavior. And here is the key. In a real squeeze environment, screen price can drop while real tightness stays the same. That's not a theory. That's how dislocations start. So tonight's move does not automatically mean silver is weak. It might mean paper got flushed. And if paper got flushed, the next move can be even more violent, because the market just removed unstable positions, which clears the runway for the next push. Why China isn't selling. In one sentence. Let me give it to you clean. China isn't selling because they don't see silver as a trade. They see it as leverage. Leverage over supply chains, leverage over pricing, leverage over industrial continuity. And if that's true, then the market has a problem, because the market is still priced like silver is available at the right price. But what if it's not? What if the question is no longer price, but permission? That's when you leave a normal market and you enter an allocation market, where the issue isn't, can I afford it? It's, can I get it? What happens next? The playbook for the coming days. Now let's get practical. Here's what I'm watching after an $84 fakeout and an 8% dump. Signal 1, does the market snap back fast? A real break usually bleeds. A shakeout often snaps back. If you see a fast recovery attempt, that means bids are still aggressive. Signal 2, do physical premiums stay firm? If spot drops but premiums don't, that's not bearish. That's the market saying paper is cheaper, physical is not. Signal 3, do delivery times stretch? This is the silent signal, not the chart, not the tweets, the clock. If delivery stretches, it means the pipeline is tight. Signal 4, does volatility stay high? High volatility means the market is unstable, and unstable markets are where forced behavior happens. Forced behavior creates gaps. Signal 5, do we see repeated fakeouts at key levels? If you see breakout, smash, rebound cycles, that is a sign the market is being actively managed by positioning and liquidity. And that often happens in transition phases. The real takeaway. Tonight was a test of who panics. Let me say this the right way. A lot of you are going to interpret tonight emotionally. You're going to think, I should have sold at $84, or maybe the top is in. That's the wrong lens. The right lens is, tonight was a stress test. It tested weak leverage, late chasing, thin liquidity, and emotional ownership. And the market did what it always does in a stress test. It punished the fragile structure. So the question becomes, was the move a signal of new weakness or a signal of the market entering a new regime? That depends on one thing. What happens in the real world after the screen move? If China isn't selling, if industrial demand is still pulling, if physical stays tight, then the drop wasn't the end. It was the cleaning. This is not financial advice. This is how to not get emotionally farmed. If you're trading paper silver, respect volatility. Don't worship breakouts. Assume fakeouts are normal and squeeze conditions. Reduce the need to be right. If you're holding physical, your world is availability premiums, delivery time trust, and whether the big players are accumulating or dumping. And if your thesis is China isn't selling, then your job is to monitor the signals that would prove you wrong, not the candle that scares you, because candles are designed to scare you. That is what they do.